All right. Today, we're going to dive into a really fascinating, high stakes business case study. And look, you're not just a spectator here. I want you to put yourself in the shoes of a top strategist inside GE Aerospace right at this pivotal moment. The question is simple, but the answer, well, it's worth billions. So let's just start with this number. $45.9 billion. That was GE Aerospace's record-smashing revenue for fiscal year 2025. I mean, that's a massive 18% jump from the year before. Right out of the gate as its own company, GE is just posting incredible results. But hang on, that one huge number, it doesn't even tell half the story. To really get what's going on with GE, you have to grasp just how dominant they are. We are talking about a global titan that holds a 40% market share in aircraft engines. But their real power isn't just in selling brand new engines. It's in the absolutely gigantic installed base. That's 44,000 commercial engines and 26,000 military engines out there right now. Every single one of those is a long-term revenue stream. And that brings us to this frankly staggering figure, a $190.6 billion backlog. This is a record-setting pipeline of future work that's already locked in. Now here's the crucial part, you right? A full 70% of that backlog comes from really lucrative high-margin aftermarket services. The maintenance, the repairs, the overhauls. That, right there, is the real profit engine for the company. Okay, so on the surface, everything looks amazing. But inside this hugely successful giant, there's a really fascinating split. The whole company is basically powered by two main divisions, and they are each on a completely different path. Let's break down how they stack up. So on one side, you have the Commercial Engines Division, or CES. It is an absolute behemoth, pulling in over $35 billion in revenue. Then on the other side, you've got Defense and Propulsion, or DPT. Now, yeah, it's a lot smaller, but this is the division with some serious momentum and a really compelling growth story. I mean, this chart just lays it all out there, doesn't it? The gap in sheer size between commercial and defense is huge. But while CS is the giant, the real story here, the thing that should make your ears perk up, is the growth in DPT. Its revenue jumped an impressive 11% year over year, and its profits, they shot up by 22%. That's the kind of growth that makes strategists sit up and pay very close attention. And look, it's not just about getting bigger, it's about getting smarter. This quote really nails it. DPT's profit margins are bouncing back, and bouncing back strong. What that tells you is that they're not just selling more stuff. They're operating way more efficiently. They're getting their execution right. And that makes the defense division a very, very attractive place to invest. So all of this internal dynamic, it creates a real headache for the leadership. You could call it a strategic paradox. You've got these powerful global forces pulling GE's two most important businesses in completely opposite directions. First, let's talk about the storm clouds. GE's massive commercial division, CES, is flying into some pretty serious turbulence. Airbus has had to cut its delivery targets. Widespread engine shortages from a competitor are actually slowing down demand for new planes across the entire industry. The whole civil aviation sector is facing some big structural problems right now. But then you look over at the defense division, DPT, and it's a completely different world. It's like a fortress. GE is the sole engine supplier for legendary fighter jets like the F-15 and the F-16. And with global military budgets soaring over 10% a year and geopolitical tensions on the rise, well, let's just say demand is rock solid. They are getting record orders. So there you have it. The commercial division is facing headwinds, while the defense division is a fortress of demand. And this brings us right to the heart of the matter, the billion-dollar decision facing GE's leadership. With these opposing forces at play, where do you place your next big bet? Now, to understand their choice, we need to quickly talk about something called CapEx, or capital expenditure. Put simply, this is the money a company invests in its own future, on things like new tech, better factories, and R&D. So this decision is really about where to pour billions of dollars to shape what this company's going to be in the years to come. And here it is, the core trade-off. Do you go all in on that secure, growing defense business? Because if you pour tons of money into military R&D, you risk starving your commercial business, the one that's been the cash cow for years. And that could open the door for a major competitor like Rolls-Royce to swoop in and steal critical market share, especially when the commercial market finally bounces back. So now, It's over to you. The data's on the table. The paradox is crystal clear. We are putting you in the CEO's chair. This is your strategic call to make. You've got two clear paths in front of you. Path A is to bet big on defense. You pour that next billion into military R&D to capture that long-term, super durable demand that's pretty much insulated from economic cycles. Or there's path B. You hedge with commercial. You invest in expanding that incredibly profitable services business, making a bet that the commercial aviation market is going to come roaring back. So, you're the CEO. What's it going to be? Do you build the fortress even higher, or do you get ready for the commercial skies to clear? It's a billion-dollar question, and there is no easy answer. What's your call?